I went to a job interview with Larry Hite in the late 80s. The book called Market Wizards came out right around that time, and I remember him handing me a copy and asking me to read his chapter. There was a question by Jack Schwager, the former best person who asked questions better, but now you're doing a better job, interviewer. And he asked Larry what makes Mint, which was the name of the first fund that Larry started, what makes Mint good, or what's the edge, something like that. And coming out of science, I expected an answer like, we have better PhDs, I was expecting a scientific answer. And the answer in the book, this is quote now, because we know what we don't know. And I was like, you have to be kidding me.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Okay, so it's been a while since I published my last episode, and so first of all, thanks for being patient and sticking with me and the podcast. However, I hope you will agree with me that it's been worth the wait, because what I have in store for you today I think is really unique, and something that I've never done before. So far I have focused on very detailed one-on-one conversations with some really interesting and successful traders, and I've been overwhelmed with your positive feedback. I have published what I think are some useful ebooks written by experts that I hope will highlight some important issues that can help you, regardless of whether you are an investor, a trader, or just interested in the markets. Every day I publish my trend barometer that explains the environment for a typical trend following strategy, and the daily market score that gives you full insight and transparency to how a classical trend following system will be positioned today and how strong the market trends are. But there is one thing I had not done until now, which I really wanted to try, and that is to bring some of these successful traders together on the same episode to discuss important topics about trading, and initially focusing on systematic trading. I wanted to bring you a unique opportunity to hear some of the best minds in our industry share their most valuable insights and debate their views in a new and exciting format. But as we are all busy people, it took some time to find an opportunity to sit down in the same room and have this discussion. But the good news is we managed to do it. And with the help and support of our good friends at Barclay Hedge and Sol Waxman in particular, today you'll be able to hear part one of this conversation. But of course, when you try something new, you always face challenges you did not expect. And this was no different. For example, we had the cleaning lady who decided to vacuum right outside the room we were in during our conversation. And the fact that we had to turn off the air condition to avoid background noise, which made it a very hot event to say the least. But despite these challenges, I think the result is as good as I could have hoped for when it comes to production quality. And as for the conversation, I think my guests were amazing. So let me reveal who is on today's episode and how you'll be able to distinguish one from the other, since I, as the untrained moderator, did not always mention their name before they spoke. The three guests represent three of the legendary firms in the CTA industry, with a combined track record and experience of more than 100 years. Campbell & Company, ISAM, and Dunn Capital Management have all had a huge impact when it comes to systematic trading and trend following in particular. And I was honored and privileged to sit down with Katy Kaminski, who previously had joined me on the podcast before she had joined Campbell, Alex Greyserman, who is the chief scientist at ISAM, and whom you will recognize due to his deep New York accent, and Roberto Osorio, my Brazilian colleague at Dunn Capital Management, where he heads up our research, and who has been responsible for some of the newest and most innovative improvements to our trading model in the last 5 years. So as you can hear, the lineup is pretty amazing, and since this is a new format for me, do let me know what you think. And if you would like to hear more of these kind of episodes, leave me a comment, send me an email, give the podcast a rating and review in iTunes. It's the only way for me to know if I'm adding value to your day. Now let's get started with part 1 of my conversation. I hope you will enjoy it. Katy, Alex, and Roberto, thank you so much for being with us today. I really appreciate your time. Now, today's conversation will be very different as I have all of you in the same room. And since you all represent some of the most legendary firms in the CTA industry with a combined experience of more than 100 years. So I think it's safe to say that we'll have some very unique discussions in store for our listeners. So let's jump right into the first topic of the conversation. Now, many years ago, Lady Thatcher said, if you don't understand history, you might be condemned to repeat its mistake. So let's start with another lady. So you, Katy, why don't you set the stage for our conversation today by telling the history of trend following based on some of the research and studies that you and Alex did in preparation for writing your latest book, Trend Following with Managed Futures, The Search for Crisis Alpha, which, by the way, I would recommend anyone interested in this strategy should go and get a copy of.
Thank you, Niels. And I think Alex would agree with me on this, is that in our book, we decided to start with history because history is, although, it's not as precise in terms of the mathematical, whether or not you can agree that the exact numbers of your analysis, but history really provides some context for us to understand why momentum as a strategy or trend following as a strategy has persisted throughout the ages. What we found, we started off our book by examining 800 years of data on trend following and demonstrated that trend following strategies or momentum approaches work over the centuries. I'm sure Alex can also add a little bit more here as well, but we also looked at crisis alpha. We looked at sort of how momentum strategies work during periods of difficulty for equity markets over a 300-year period. And what we found is, trends have always existed. Momentum has always been a phenomenon in financial markets, whether it was in the Middle Ages or it's today. We've always seen herding effects. We've always seen that there are opportunities to follow trends in markets. So maybe I'll turn that to you, Alex, and add some other comments as well if you want.
Yes, thanks, Niels, for inviting us to spend this time together. Katy and I started looking at history, and I saw some of the papers from some of our competitors talking about 100 years. I saw a paper called 200 years, and then I figured we have to top that. So this is the first time I realized that Excel cannot read dates before I think it's 1600 or 1500 or something like that, because we actually had data. We actually had data over 1,000 years.
Wow.
People may ask, well, what kind of data is there? And there's things like Bangkok rice and hardwood and bond markets, which I didn't even realize go back to 1300. Equity markets to the 1600s, black market, British pound data, all kinds of things like that. And of course, these markets are not tradable. There wasn't necessarily a prime broker that you could short, and commissions would have been high and all that. But it still gives us a great perspective on the benefits of trend following. I think it's in chapter 1, there's only one table that somebody should look at in the book. Don't know exact table, but it's in chapter 1. and it lays out the combination of 50-50 trend following equities and 50-50 trend following bonds over 800 years. Mm-hmm. And it shows low correlation and benefits of diversification. And if that's not, the best possible evidence for having this asset class in the portfolios, I'm not sure what else is.
When do you think, by the way, that trend following as a concept that we know today, when does that really date back? What's the sort of the first evidence of trend following managers? I mean, I know that the three of you represent some of them, but are there anyone that you can think of that was even earlier with trend following as a concept?
I would say, if you look back at the firm I represent, they've been around since 1972.
Sure.
But I think people have been trend followers forever. What is trend following? It's cut your losses when the prices go down,
sure.
Buy when things are going up. Alex and I had an example in our book, which is kind of funny, but it's a good example. You look at the tulip crisis. That was a spectacular event, but if you'd been a trend follower, you could have actually made quite a good return,
sure.
By just remembering to cut, if you just cut some of your losses prior to that bubble bursting. So as long as there are bubbles, as long as there are inefficiencies, as long as people occasionally exhibit irrational or hurting behavior, momentum will work.
Sure.
I think the key, if we can interject, is the social psychology. Right? People show herd behavior. People like to follow each other, and this is not going to go away. It's inside our brain hardware. That's why I believe that trend following is not going to go away soon. It is also this first chapter of Alex and Katy's book is a very impressive piece of evidence of how long it has been around. And the fact that it has been around for, 1,200 years at least, is a good sign that it's not going to go away in a decade or so.
Wasn't there always, there was also a quote in the book that you, like from 1700, what was that?
Keep your losses, cut short your losses, and let your profits run on.
Yeah.
That's the first quote of the book, and it was from the legendary political economist.
Is it Ricardo?
David
Ricardo.
David Ricardo, 1821, I think. Yes.
This is not magic, though, and that's actually in the 1700s. I think there was a 50-year period where would have had a very low Sharpe ratio and a big drawdown. So this is not magic. And I guess later, and I think it's chapter 4, we talked about the behavioral biases that creates these things. But at the end of the day, this gets into timing or inability of timing this strategy. So people talk about timing last year or the year before and how they should have gotten out. But we tested this for 800 years, and basically there's no timing skill. So this is just one of these, at least our argument is, one of these permanent asset classes that one must have in a portfolio.
In futures, as Campbell Dunn has also been around since the 1970s.
Sure.
You find, in the literature, you'll find evidence for momentum in stocks in the early 1990s. There's a paper by Jagadish and Titman, I think it's 1993, who actually in the title says buy the winners and sell the losers or something like that. And that's a good strategy. That is, there are hundreds of papers since that one about how trend following works in stocks. As far as the historical evidence is concerned, I also came across a couple of years ago by a paper by the group of Jean-Philippe Bouchot at CFM in Paris, where they analyzed a shorter time span. I think it's 2 centuries of trend following behavior. So the evidence is just overwhelming that this is probably the most, in my opinion, this is the strongest evidence against the axioms of efficient market theory.
Sure.
I think if we turn a little bit more as well, one of the things that Alex and I looked at as well was thinking about this concept of what is trend following capture. And what we discussed in our book is trend following is a divergent trading strategy. So what you're doing then is you're cutting your losses and you're following your winners. And what are you trying to capture? Well, you're trying to capture divergence, movements across markets. So you can see why a lot of people think, well, there are no markets are efficient.
Right.
Technology, everything is getting more converging to be more efficient. So Alex and I actually tested that hypothesis because we looked at the measured divergence across markets over a long history. I think, wasn't it back to 1962?
Mm-hmm.
Mm-hmm.
And the idea is to test the stationarity of divergence. Is it decreasing? And the evidence doesn't seem to appear so, which means that there are always periods in time where markets must readjust and where things have to diverge to go to some new norm, to some new equilibrium. And it's that process of us as market participants trying to figure that out that creates momentum.
Sure.
Right.
So our goal is just to try and capture that systematically.
Sure. Before we jump to the next topic, I want to ask sort of a slightly personal question about your own history with trend following. So let me start with you, Alex. If you could share sort of your first experience with trend following, and I seem to remember a story when you met Larry Hite for the first time, so maybe that's the starting point, but I'll let you share what you remember.
I came very close to staying in engineering. I went to a job interview with Larry Hite in the late 80s. The book called Market Wizards came out right around that time, and I remember him handing me a copy and asking me to read his chapter. And there was a question by Jack Schwager, the former best person who asked questions better, but now you're doing a better job, interviewer. And he asked Larry what makes Mint, which was the name of the first fund that Larry started, what makes Mint good, or what's the edge, something like that. And coming out of science, I expected an answer like, we have better PhDs, I was expecting a scientific answer. And the answer in the book, this is quote now, because we know what we don't know. And I was like, you have to be kidding me. I'm about to leave. I was working at RCA doing high definition television signal processing, all this geeky, cute stuff. So he did offer me $4,000 a year more. And so I did take the job, but I was kind of very hesitant because it all seemed like a psychology thing. But that actually is the essence of actually, it's one thing for us to put this on paper and say this worked. It's another thing to actually have the discipline to follow it.
Yeah.
And so that was my first experience, basically knowing what we don't know. And probably truly to this day, if you ask me what the edge is, that's the edge. Yeah. The edge is knowing what we don't know. I'm not going to get all Donald Rumsfeld on you with the whole known knowns and known unknowns, and so don't try that question on me.
No, but I do want to follow up on that before we hear what Roberto and Katy has to say about it. But one thing is to be exposed to trend following. Another thing is to really believe and start, trusting trend following. How long did it take for you to get to that stage? Because that's obviously not something you get to just by reading a chapter.
Yeah, it took me years, probably 5-10 years. The comfort level with having more losing trades than winning trades, we're constantly losing money. The comfort level with the risk aversion and the stops, and okay, we take a loss and we move on. There's just no mental reaction. There's no reaction to try to data mine parameters, rerun the systems. The discipline to do this is actually easier said than done. I'm going to tell you kind of like a slightly parallel story because I'm involved in academics and I teach. And I find that the combination that at least we look for in researchers, I'll tell you what the combination is in a second, is actually extremely rare. It's extremely rare to find very smart people who are very humble. Maybe I have two next to me, but
I'm extremely humble, and I'm proud of it.
And it takes a set of people, at least I can talk about that in our organization, that we're just wrong most of the time. It's in the trades. Yeah. It's okay, and having that humbleness together with the ability to actually run these systems, have discipline, is actually very unique. I'll tell you, 99% of the students I teach at Columbia are not humble. No. They think they can walk on water. And this is maybe why, maybe this is getting a little advanced, but maybe this is why the strategy works, is not that many people can actually follow it. Most of the world and most of the participants in the investment management industry tend to be mean reversion type players. Sure. And, we actually provide the liquidity and, maybe this gets all into technical, but most people actually, it's almost not possible for this to go away. Maybe that's why it's worked for so many hundreds of years. It's not easy for the majority of people to actually have the discipline to do it. They're going to want to override, they're going to want to do this, they're going to want to do that. So it took me quite a while. It's not just something you kind of like read in a book.
Sure. No, absolutely. Now, Roberto, we are, of course, colleagues at Dunn, so know a little bit about your background, which includes another strategy, namely statistical arbitrage. But I actually don't know how you got your first exposure to trend following. So why don't you share that?
I'm originally a PhD in physics, and after I got my PhD in physics in Berkeley, I went back to Brazil to be a professor of physics. Then I was in the United States for a sabbatical in the San Francisco Bay Area. That's how I got my job in this mean reversal strategy. That's what stat arb is in the world of equities. And then I decided not to go back to academia because I need some money to buy milk for the kids.
Right.
That in the late 1990s, I got. The late 2000. The late 2000. How do you call it? The late noughties.
Yeah.
I got my first exposure to trend following at Dunn. Although we had in the same company in San Francisco, which is called Avenine and Associates. It's non-existing now, but together with the stat arb model, we start to do some research in trend following in stocks along that line of that research that I mentioned buy the winners and sell the losers. We never actually got to the point of implementing. Then finally, I had that opportunity to move to Dunn. There was this job opening, and I decided it was time for a change. And I guess I got convinced pretty quickly that it worked because I started, doing some simulations, and in a few months, it looked pretty real to me that, this is really a very strong signal, and we can't ignore it. And there was a track record of decades going on there. I liked Alex's comment about the fact that humility is very important because that's one of the main psychological biases comes from this research again in behavioral psychology is overconfidence. That's called, some circles, it's called the Lake Wobegon syndrome. There's this program in NPR by Garrison Keillor, where there's this mythical place called Lake Wobegon, where every child is above average.
Okay.
That's how we all feel, right? If you do a research on how people, what do people think they behave as drivers, for instance, 80 to 90% are going to think they're better drivers than average. So it's a universal phenomenon, and that's why I agree that it's better to let the machines decide. You take out human emotion out of your decision process. Once you build an algorithm that's, you believe if you really have a good foundation, theoretical foundation to believe in that algorithm, that you're sure that you didn't fall in data mining traps. And all those other considerations that are important to do. You should let the algorithm do your trades. You can improve it, you can add new signals to it, but you should not get afraid because you have a losing month. That's part of the process.
Well, we'll get into that. What about you, Katy? How did you get started with trend following?
I actually started trend following back in my PhD thesis. So I was working with Andrew Lowe at the Sloan School, and to give a little more context, I grew up with a father who was a clinical neurologist. So when I was a kid, he was always telling me about how synapses were working to create fast and slow type approaches, and how the brain was lazy. He used to tell me that all the time at dinner time. The brain is lazy. You're going to try and find a simple approach to do this, and you have to think about how the brain is reacting to make decisions. So when I was doing my PhD, I decided to do my topic on heuristics. And I was fascinated by the fact that the academic literature kind of treated the heuristics universe, which would be trend following, technical analysis, as voodoo finance. And Andrew posed a very good question to me. He said, people in practice use these rules all the time. There must be a reason why they do. And so because of this, I said, there has to be, I combed the utility functions. I tried to find a way to kind of explain it. But what I came to realize is just how important and how useful heuristics are in investment, and how pretty much everything that we do in practice is about heuristics. I want to add one other point to what Roberto was saying as well, is that, at 50-50, the behavioral finance literature says that's your highest point of overconfidence. Mm-hmm. So if you're working in a world where you have 50-50 chance, that's when your relative overconfidence is at its maximum. So that's why we have to be a little bit worried in the state in what we do, and why it's good to have humility and to try and think about how those effects, the behavioral effects, impact us. Another thing I'd also point out that I was interested in when I was a doctoral student, behavioral connections to heuristics, was the disposition effect. Yeah. The disposition effect says that we tend to hold on to the losers and we tend to sell the winners too short. So if you think about what that does, when people are selling the winners with interesting information, you end up with some sort of momentum or trend in prices. What we do is cut the losers and buy the winners. So in some sense, we're really systematizing a behavior that is hardwired into the brain, and by allowing our systems to make decisions that typical investors really have trouble to do. So I think that is why trend following works, and that is where I got interested in the strategy at the beginning, is trying to understand, why does a heuristic work? What are the behavioral reasons that create a scenario that might make a heuristic help you to make a better choice? So why would you use a stop loss rule? Why would you decide to go into a casino with an X amount of dollars in your pocket, so that you don't come home with even less?
Yeah. So people who are following the disposition effect, or who are victims of this disposition effect, are actually our counterparties. That are people who trend following makes the money.
Did it take a long time for you to be convinced that this really is, solid, robust?
Well, I was actually puzzled. Back when I was a PhD student, I had a colleague named Yasmina Hasan-Hodgic, and she's written a couple books on technical analysis. And I was really fascinated by the fact that most of the technical analysis strategies and heuristics were applied in FX. And I was very shocked by that, because I thought, as a student at that point, we're preached the efficient markets hypothesis. And I thought, I can understand maybe some sort of rule might work in some illiquid market or something like that, because, there's an inefficiency, and so you can figure out how to take advantage of that. But why is it the case that these really diligent rules using technical information work better in really liquid markets? And that particular idea stuck in my head until I went further into doing more research on trend following, and that's where it all started to come together. It's about being able to be liquid and to take those losses, follow the winners, and being able to do that dynamically over time is why those type of heuristics works. They depend on that liquidity.
Why don't we spend just a little bit of time, and I don't know whether we can sort of do that in terms of defining trend following. And what I mean by that is, in the old days, there was a very clear link between being CTA and being a trend follower is almost the same thing, but it's not so anymore. So I wonder if you, Katy, if we stay with you for a little while longer, is there a way to define trend following so that we don't think all CTAs are trend followers?
That's a very good question. I tend to think of trend following as one of the predominant strategies in CTAs, because if you really think about it, what we're trying to do is find any sort of indication of whether or not something's going up or down. So you can easily widen that definition to include other data sources, cross information. So you can think about all the different ways that you can use information to try and estimate is it going up or down? And if it's not, you cut it. If it is, you continue. So really, a lot of different strategies really classify by that. And the typical trend following definition is use an individual market's past price. But these days, we've gotten creative.
Sure.
What we can do is we can use other markets' past price, or we can create indices of markets and follow those prices, or we can even look at forward-looking information in prices to try and determine what the trend is.
What about time frame? I mean, is there some level of time frame where you say, well, if you're below that time frame, you're not a trend follower anymore. You're some kind of short-term trader, but we wouldn't define it as trend following.
I think, and I look forward to hear what Roberto and Alex say as well, is that ultimately in this game, it's a numbers game.
Right.
As Alex explained, you're losing a lot and winning bigger sometimes. So what we have to do is diversify. So to find as many atomic units of opportunities across markets to play the numbers game, to reduce the volatility in our portfolios and try and find the best risk-adjusted opportunity set.
I can jump in with that. We talked in the book about convergent, divergent, and all these kind of stuff. So to me, it's actually the way you follow the trade after you get in, which defines why whether you're a trend follower or not.
Right.
It's not, this may be confusing, it's not whether you get in after a trend. It so happens that you have to actually separate those two things. So you can get in after a market's actually gone down and go long. I'm not saying we do this, I'm just saying conceptually. Yeah. But then when you go long, if you do it with some sort of a trailing stop, you actually a trend follower in your trade, and you have what we call a divergent payoff profile.
Sure.
So actually, this is one of the, after I read the chapter, We Know What We Don't Know, the next thing that I did, this is 25 years ago, was this kind of a piece of research which opened my eyes to a lot of these things, which is what we call a random entry system, which is where you flip a coin. This is the simplest way a practitioner can do this.
Sure.
The problem is they may not hire us and we don't make any fees, but this is the simplest way your listener or your listeners, I guess, can do this. So get a coin, a proper coin with the heads and tails, flip it, and let's just say if it turns up heads, you take a long position. Let's just say we're talking about just one market, no big portfolios. If it ends up tails, you take a short position. So if it goes heads, you take a long position, you set what we call a trailing stop. Some kind of simple calculation of maybe one standard deviation or something like that. So let's say the price is at 100, you flip a coin and it tells you to go long, you set a stop, let's just say 10 points, because that's maybe some measure of volatility, and off you go. So if it goes to 101, the trailing stop goes to 91, and at some point you'll obviously get stopped out because it'll turn around by at least $10 in this case. When that happens, what you do is you flip the coin again. Okay, and if you get heads again, then you go long again with another, let's say, $10 stop, just to keep it simple. And off you go like this. Obviously, if you run this in the computer, you're going to get all sorts of results, and you have to average them out, etc., some kind of a simulation. You will get maybe half of the results of a professional trend following system, because you will sort of, this was kind of opened my eyes to this in the early 90s, you actually stumble onto trends. Now, this is a philosophical argument we can have between three PhDs here.
Sure.
Is it trend following or not? Because I am not using any past prices at all. I'm just flipping a coin to get in. I am only money managing. See, in the early 90s, when I worked with Larry Height, he didn't know any buzzwords. He went to NYU and majored in film studies. So we didn't know like alpha, beta, optimization. Even trend following wasn't a common word. It was just really just a form of risk managing your portfolio.
Right.
You know, in fact, all these meetings now, all day long, people ask me about these fancy questions because they read all these textbooks. It'd be much better to go back 25 years ago and talk about what it is that we actually do.
Sure. Yeah.
You know, rather than, well, what's your alpha and beta? And then, you know, maybe half the people don't even know what that means to begin with. Yeah. Anyway, back to you might have to cut that out. Back to the coin flipping. So is this trend following or not? Let me just ask Katy or Roberto this question.
Let's do that.
The thing I just described, is yes or no, is that trend following?
What do you think?
Yes, it's trend following, but you're still using the past history. Once you are in a position that was decided by a random event, coin flip, you're going to keep a positive position if price had gone up in the recent past since you started the position. So in this sense, it is trend following. You're following momentum to decide if you're going to exit or not. So I view the position that you take at each point in time as really more important than the act of getting into the position.
I'll tell you a quick thing. I teach a class at Columbia.
Sure.
And before the first class, I asked people a question. These are all smart students. Maybe not as smart as MIT, but they're pretty good. Cut another one out. So I asked them, there's 3 things to any trade. People make it complicated. We're doing this taping during a major conference for the industry, and there's all sorts of smart people, and everybody tries to make everything very complicated, maybe us included.
Sure.
But at the end of the day, there's only 3 decisions to any trade, period. When you get in, or any investment, when you get in, when you get out, what's the size of your position?
Yeah.
Okay, so I ask in my class, what do you think, class, is the most important of those 3 in some kind of order? Getting in, getting out, or sizing the position? And invariably, most people think that getting in is the most important thing. Now, grant you, in some investment categories, it probably is the most important thing.
Sure.
Probably if you buy real estate, if you buy some crap and you can't get out, you have to actually understand getting in is very important. But in liquid instruments, which is more or less what we're talking about, it's actually the least important.
Sure.
And so all this CNBC talk and all this talk about forecasting and everything is actually the least important. And then I make them do this exercise. So, yeah, I think we all agree this is trend following, and we're obviously using history to keep the position, but we're not using any history whatsoever to decide whether to get in.
Right.
But Alex, I'd say that if you look at that example, I like that example because it divides the 2 apart. But going back to the example I was talking about as well, is that trend following is really 2 pieces, right? One is how you determine your position, and then the other is that you're consistent with the trading approach, that you cut the losses and you follow the winners. Right. So it depends. I mean, which lever you're considering more of the trend following. I think that the decision to get out is really more of what makes a trend following position.
In this example, I think the transaction cost is an important component. Like Alex mentioned, real estate, of course, getting in is important because, it's not a liquid instrument you're getting in. If liquidity is high, I really see every moment as a decision point. If you hold a position, you're making a decision at every moment if you're going to continue to hold that position, or if you're going to decrease or increase, or if you're going to get out completely, or even if you're going to take a reverse position. So there are different components of trend follow. You can divide into get in or getting out, or exit points, stop loss strategies, whatever. But really, I like to see every point in time as a decision moment, if you want. Of course, there will be some granularity in this. Most people will use every day as a decision point.
A lot of people say that trend following is easy and there aren't that many ways you can do it. But on the other hand, I don't think that firms like yours would spend so much money and time on developing research systems, infrastructure, if it was that easy. So what's fact, what's fiction about how difficult it is to be a trend follower?
That's an excellent question, Niels. I often like to turn again to another behavioral effect. We as individuals tend to suffer from something called conjunction fallacy or representative bias. And what this means is that we tend to think that 2 things that we think are representative of each other are highly correlated. So good companies are good investments. For example, a good company actually should be a properly priced company, so therefore it's not necessarily a good investment.
Sure.
In our space, this occurs in the following sense. Investors tend to think that high correlation means similar returns. And what I mean is that it's very, very easy to replicate just as Alex's example showed, a strategy that has high correlation to trend. Mm-hmm. But in practice, to have a high risk-adjusted return or good performance in this space really requires acute attention to detail, making the day-to-day decisions and risk management. And I often am quoted in saying, the devil is in the details.
Yeah, absolutely. You can have two time series that have perfect correlation, and they could be simulating a return series where one has a positive drift and another one has a negative drift. So the correlations go back to style analysis or factor analysis. These will be reflected in the styles or factors or principal components if you do it in a statistical basis. But there's always an alpha left, and that will distinguish different managers that may look very correlated, but are really doing different things, because the alpha is whatever is not captured by your styles, your factors, or your principal components. These are things that may be very unique. And I agree completely with Kate that hell is in the details. The implementation, or the devil, is in the details. Be a little less rude. But the details of the implementation and efficient software, making sure that there are no bugs, no interruptions due to defective software, all this type of dirty details is very important. This is like, having a CTA based on systematic methods, just basically going to have software to make your decisions. It's very important, like in any machine shop, that all the gears and levers are in the right place. And anything that, if there is not very good management of those details, you can have catastrophic events like, wrong trades because of bad line of code, and some event that may happen once a year or once a decade may kick in and trigger that bad line of code.
Sure.
It's very important to then have very careful code review, testing platforms, testing protocols.
Sure. No, so
let me like Roberto, as a physicist, talks about gears and levers. Let me, maybe to your listeners, explain this maybe a little bit more plain English. Most people invest in equities. Mm-hmm. Okay, most people will think like, okay, so what am I going to do here? I'm going to get that coin out. I'm going to apply a trend following system somehow on the S&P. So you have to realize that the Sharpe ratio, or the information ratio, or the reward to risk, or however you want to measure it, and one market and any trend following system is extremely low. Mm-hmm. Let's just say, for sake of argument, it's 0.1, 0.2, whatever the exact number is. If we subtract risk-free from the Sharpe ratio, not, or let's just refer to it as just return over risk, more or less, and let's just say it's something like 0.1.
Sure.
That is extremely low, too low for any investor to actually rely on, too low to use. By the way, it's too low for any energy company or McDonald's or anybody to actually not use the actual markets for hedging and rely on moving averages not to hedge future prices of oil, which is what creates opportunities for us. But anyway, backing up, so one market our Sharpe ratio is extremely low. So anybody who's going to try to say that, okay, let me use some kind of a simple trend following system to get me out of my equities or to go short, is doomed to fail. The information ratio is way too low.
Yeah.
What makes a professional, but that's probably what somebody's going to try to do. Take a few markets and just apply it. And if you take a few markets, your information ratio obviously will go up, but it'll go up to 0.2, 0.3. It's too low for any practical purposes. So what we as professionals do is we actually aggregate these so-called trend following risk premiums, if you want to use buzzwords, or just simple P&L from different markets, and we aggregate them. Aggregate how? By trading many markets, few hundred markets or such, markets that most people wouldn't even follow or know that they even exist. All the bond markets, all the currency markets, all sorts of things around the world. and also applying different speeds, which we haven't really talked about, but there's different speeds of trend following.
Yeah.
And so what we do, when we say we collectively as an industry, is we try to take that information ratio from 0.1 to 0.5, 0.8, 1.0, something competitive to the information ratio of other asset classes, which is somewhere in that high 0 point, some high number, 0.9, 0.8, 0.7, depends what you look at. And that makes it then a compelling asset to consider. But it has to be managed across a wide portfolio of markets, sectors, speeds, and not just one thing on one market. That little random entry coin flipping thing will only produce a Sharpe ratio of maybe 0.1 for one market.
Sure. So when we hear people say that it's trend following is easy, it's not that easy for sure.
No, and that's part of the cost of entry, the fact that you need a good number of markets to be properly diversified. And futures contracts are not cheap.
Sure.
A future contract is typically a few tens of thousands of dollars. And of course, you don't, when you enter in a future contract, you only need to put the margin, but still you're talking about, you need a few $1 million after you have a proper
diversified
model, a proper model to trade and trend following. And so there is a cost of entry. That's not trivial.
Another myth, so to speak, that we often hear managers mention when they ask how they build their trend following systems is that often they say that the most robust systems are the simplest ones. Is that really true? What do you think, Alex?
Who said it? That I don't want to now, Roberto, tell me that I misquoted somebody.
No, exactly. I'm not going to stop quoting anything right now.
We now have to retape this whole thing because now he has to go first instead of Katy. But who said, was it Einstein? Keep everything simple but not any simpler? Was that
That's
something along those lines?
Attributed to him.
So, yes, simple, but, it depends on, not going to be a Bill Clinton here, but, it depends on what definition of simple is.
Sure.
Right? There has to be, we use these words like robust and all those kind of statistical words that has to be, has to be solid and rigorous. And, there's scientists we have on staff, all of us collectively for a reason. It's relatively speaking simple. But if you do that, the very, very simple version, that's probably, in my mind, it's probably a range of about 100%. So what I mean is like a factor of 2 to 1, maybe 3 to 1 between a very simple approach, a textbook system from, what was it called, the Handbook of Futures Markets or something, on a small number of markets that you implement in, TradeStation or something like that. You'll get a result of, X, and a professional version across all markets implemented with, market access and connectivity and low transaction costs and diversification and timeframes or whatever. It's probably 2 or 3 times X. You're not going to get a factor of 100.
Sure.
But you'll probably range at the end of the day in your kind of information ratio between 0.3, which you can get from that random entry in a couple of markets, up to maybe 1.1. But that's, that's a meaningful difference in terms of your expectations for performance going forward. So that's probably about the range that you're going to get.
Sure. Katy?
Well, I would also say that, we have to go back to the 50-50 situation here again. That, and Alex's points about being humble, is that really in the business we're in, where it's very difficult to forecast and predict things, you need to be substantially proven that there exists evidence contrary to 1 over n.
Right.
To the heuristic that we all have ingrained, these simple heuristics. And to give an example of that, one of my favorite papers in the literature was one that looked at the 1 over n diversification effect. Some researchers from London Business School looking at all these really fancy asset allocation models in the academic literature. And what they found was that the 1 over n heuristic over long time horizons often tended to beat them. Mm-hmm. And this kind of gives you some intuition about how to think about why we think so much about trying to use a very simple approach. Mm-hmm. Because even if you take another simple example of mean variance analysis, I spent several years teaching MBA courses, and we sort of beat mean variance analysis to death, right? And in this process, we do mean variance optimization, and what you see is, it's very unstable. Yep. Very, very unstable. Yet we spend a lot of the time sort of teaching that. But even the research on that shows that the minimum variance portfolio out of sample significantly outperforms mean variance. So what this tells us is that the simpler and the more sort of robust and simple the solution is, the better. So Alex and I had done some work on this as well, is that over long time horizons, the typical market-based trend following approach tends to outperform. So 1/n. So you allocate equal risk to every market. That particular strategy over long time horizons does very well. True. Because it basically has no view which market's going to do better than another. You need to, if you're going to have a view, you need to have proof as to the contrary. And proof is hard to ascertain in a world where you're stuck at 50-50 or 51-49.
Yeah, it's the role of uncertainty that really makes mean variance not to do the job that some people expect, that theoretical financial economists would expect it to do. Because, like Katy said, we don't know what the expected returns are, or if at the most you make a bet that, let's say an informed bet, that things are going to go up or down based on some statistical evidence of how they behave with respect to their past history. But it's very hard to be any more precise than that. And when you put that in a mean variance optimization engine, small changes in expected returns yield very different answers. Going back to the problem of simplicity and complexity, I think, in my opinion, you should not introduce complexity gratuitously. I think Einstein said that we should be as simple as possible, but not simpler than granted by the problem. I'm paraphrasing now. Probably worse than he put it. So the idea is that the components should be simple. The components of a model should be simple. But once you have new signals, you should introduce those signals in a way that's not, it's not a Ruth Goldberg, machine, if you know what I'm talking about, those famous old comics where you have those very complicated complexions to just draw a ball from point A to point B. We don't want to do that. If you want to grab some effect, you have to try first the simplest way possible. Then you can introduce a bit of overlay of, let's say, granted complexity that is granted, that's ensured by the evidence that you have, by the data evidence that you have, that this added complexity yields bad results. And this has always to be done very carefully because, again, you don't want complexity for the sake.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.